So this is VU and this is SPY, and they both track the S&P 500, but sometimes they actually produce different returns. You can even see on VU's fact sheet that year to date it's returned 0.62%, while the benchmark has actually returned 0.68%, and so that's a 0.06% gap. This is actually called tracking error, and every ETF has some sort of version of this. And one of the reasons this happens is because of fees. So even a tiny expense ratio can create drag. So VOO charges 0.03%, but there are ETFs out there that charge 0.2% or 0.5%, and this can affect your returns over time. The second reason is called cash drag. So when money flows into the fund, it doesn't get invested immediately. There may be a period where it sits on the sideline, so that can affect overall returns as well. And third is how these funds actually replicate the index or a sector that they are following. Some ETFs will buy every single stock in the index, and others will only buy a selection of stocks. But that's usually for more niche ETFs. With both of these S&P 500 funds, they both include every stock in the index, so it's most likely that the first two reasons are actually contributing to that tracking error. The bottom line is that for big liquid ETFs like VU, SPY, IVV, etc., the tracking error is so tiny that it's not a huge factor to lose sleep over, but on smaller ETFs, you may want to pay attention before you buy.